So trading of international currencies clearly involves selling one currency and buying another of the two currencies involved. And these two currencies involved are described as pairs. We're basically not trading the euro itself or the dollar itself or the Japanese yen itself. We are trading the currency pairs in the FX market. So the price at which a pair is bought and sold provides the exchange rate. So the one that you see, the numbers that you see on your MT4, those are the exchange rates. So when the exchange rate is being quoted, the name of each currency is abbreviated to a three-letter reference. For example, you'd find the British sterling, the British pound sterling, is abbreviated as GBP. And the euro is abbreviated as EUR. The dollar, the US dollar is USD. The Swiss franc is CHF. So basically, we'll be trading these currency pairs, and most commonly quoted currency pairs we find the US dollar against the Japanese yen, euro against USD, USD CHF, pound USD, euro pound. So these are the common quoted currencies. So when currencies are quoted, the first currency is the base currency. So here, for example, for EURUSD, the euro is the base currency, and the dollar, the second currency, will be the quote or the counter currency. So the quote currency. The base currency is always equal to 1 unit of that currency. Basically, for EURUSD here, it will be like 1 euro. For USD it will be $1. For GBP USD, it will be £1. So if you find the exchange rate for EURUSD is 1:1.1165, it simply means 1 euro is worth $1.1165. So when the exchange rate is described as going up, it means that the value of the base currency is rising relative to the other currency. So the base. So when the market is going up, it simply means for EURUSD, when the market for EURUSD is going up, it simply means the euro is stronger or the currency is strengthening. Or it may be maybe the dollar is weakening. But when EURUSD is falling, when the market for EURUSD is falling, when the exchange rate is falling, you find the euro is weakening or the dollar is strengthening. So it's either of the two. So the international currency market is primarily an OTC market, an over-the-counter market. That is one where brokers and dealers negotiate directly with one another. So you find you're filling your order to the broker will communicate directly with the dealers, who are also called as liquidity providers. And there is where your transaction is completed. So the main participants are the large international banks, which continually provide the market with both the bid, which is the buy, and the ask, which is the sell price. And the difference between the bid and the ask price is what we call the spread. Central banks are also major participants in the FX market. So they use it to control the money supply, inflation, interest rates. So also you find that central banks for certain currency will counter a certain trade in the market so that they would simply control their currency movement. So an OTC market is not under the supervision or regulation of a central exchange. So basically this market is decentralized. And there are several types of transactions and financial instruments that are commonly used in the FX market, but the common transactions we we will be learning on the spot transaction and the forward transaction. So for a spot transaction, the spot rate is the rate quoted by a bank for the exchange of one currency for another with immediate effect. So basically what we see on the FX market, the exchange rate that we see, the ask and bid prices that we see on the FX market, those are for the spot transaction. Those are spot rates. So in most cases, the spot rates are usually settled, and the settlement is usually T+2. So currencies actually change hands and arrive in recipient bank accounts. And we also have forward transactions. For a forward transaction, here a buyer and a seller agree on an exchange rate for any date in the future. Like these are like future markets. For a fixed sum of money, and the transaction occurs on that date. And we call that date an exercise date, regardless of what the market rates are then. So we agree today on the exchange rate that we'll be using on a future date. And when that date or the exercise date arrives, we would exercise our transaction regardless of what the market rates are then. So the duration of the trade can be a few days, months, or years. So for forward transactions, they're not like on the spot market. They're simply future markets. So basically, what we are trading on the FX market are the spot transactions. For forward transaction, you'll find brokers like IQ Options, where they have the options for these currencies. You'll find those are the forward transactions taking place right there. Because for forward transaction, it is mandatory for you to exercise your part when the exercise time arrives. So unlike other financial instruments, there is no public record of the trades carried out, nor the amount that the trades represent. So having known this, we basically do not have an order book, which is a real-time order book for the FX transactions. So basically, we'll be relying more on the technical analysis on the charts in our analysis in order for us to anticipate for the next move and take our trades and profit from them. So thank you for listening. Till next time.